Welcome, everybody, to Behind the Capital Curtain. As you well know, this is pulling back layers of complexity in the world of business and commercial real estate deals to reveal what really drives top-tier investment opportunities, hosted by me, Dave Kotter. The show explores the art and science behind investing in exceptional businesses and commercial real estate deals and structures. Each episode is a deep dive into the structures, the strategies, secrets that make standout investments successful, whether it's breaking down an anatomy of a $50 million industrial acquisition, decoding waterfall equity structures, or utilizing third-party associations, and even uncovering how to identify off-market gems. This podcast is your backstage pass of how sophisticated capital really works. And I'm really excited to have on the show today with me, Ethan Russman. Ethan, thank you for coming on the show.
Dave, thank you so much for having me. Really appreciate it.
So Ethan Russman is a partner at Cyna 1031 Advisors. Cyna 1031 Advisors promotes investment advisory and financial planning solutions focused on tax-efficient and tax-deferred investment strategies through its relationship with Immersion Equity LLC. Cyna specializes in collaborating with clients who own real estate as an investment or through their business holdings and who may require deferral on the tax implications upon the sale of their property. Ethan is a CFP, which is Certified Financial Planner, has worked and consulted for an investment sponsor, financial planning firms, and family offices as it pertains to alternative investment solutions, or what we call alts. 2006, started working at Cole Capital, which was an early adopter and provider of the Delaware Statutory Trust structure, DST, which we'll be talking about today, which allows investor access to institutional quality 1031 solutions. Before Cyna, Ethan spent 9 years at Cole Capital, a former commercial real estate investment firm headquartered in Phoenix, Arizona. Among his duties, Ethan was the vice president of product management from the inception of the public listing of Cole, which is a publicly registered company, and has had $7 billion in assets under management when it was listed on the New York Stock Exchange in 2013. And so I'm really excited for us to be diving into this whole concept of 1031s and demystifying. So let's just start at the foundation as, what do most investors get wrong? Because we kind of hear 1031 exchanges. And why is the Delaware Statutory Trust structure such a game changer in this particular space?
Yeah, Dave, good question. A Delaware Statutory Trust is a special purpose legal entity. It's a trust in which a sponsor company, an issuer that's raising capital, they conduct due diligence, they acquire the properties, they obtain financing on those properties if necessary. They hold title to the property and act as trustee to the trust. The investor, in this case, is no longer an owner of real estate. They become a beneficiary of a much larger trust. Now, DSTs do allow for fractional ownership with, could be up to hundreds of investors who share ownership in a professionally managed portfolio of properties. Now, DSTs are a way to defer, and we'll probably talk about this throughout this discussion, a way to defer the various embedded potential taxable gains without actually owning real estate. So you become a beneficiary of a trust. The trust owns the real estate, and the trust does just about everything, and the investor collects income via the trust. There's typically no more tenant and property management related issues. This can be a game changer, is your question. This can be a game changer for the right investors and their situations.
That's fantastic. Sounds like a great vehicle to utilize. So how do you guide real estate kind of heavy investors through the mental leap from actively managing property to embracing a passive institutional quality DST solution? Because that's a big issue where maybe an investor's been actively involved in things for such a long time, and now they're sort of transitioning into more of a passive. So walk us through that.
Yeah, this no question can be a real challenge. Behavioral finance has become as critical as actual financial planning and investments. And behavioral finance meaning the investor's psyche and their emotions behind an investment. And Dave, as a lifelong entrepreneur, doing millions of others, are used to having control,
Mm-hmm.
autonomy, and full decision making. It's their money; they made it. So when an investor decides to do a 1031 via a Delaware statutory trust, they give up control in all decision making. Although it's not perfectly analogous, sailing your own sailboat is very different than taking a cruise. And it really is critical, at least for me and many others, is to ascertain what are the client's goals, needs, requirements, etc. And many things come into play when you're going from actively managing real estate to passively. And that could be age, health, estate planning goals, income requirements, and even in many cases, emotional attachment.
It's a real thing. There is for sure. So in what scenarios is a tax deferred strategy like a 1031 exchange not the best option? And what would you say are some of the hidden pitfalls that savvy investors should really watch for?
Yeah, well, this is maybe the most important question, and of course, depending on the situation. For some, there are a number of several important factors where an investor or business owner should not do a 1031 or a DST. Obviously, you want to collaborate with your tax professional and attorney when you can. And here's just a number of reasons why you shouldn't do one. And this is more of a financial planning pitfall. You have other significant financial responsibilities for your family or your business. Possibly the overall impact of your tax implications is minimal. Just because it's tax deferral doesn't mean you should actually do it. Your age, stage in life, liquidity requirements potentially take precedence over tax deferral. You don't have any estate planning needs or beneficiaries. You got some insurance premiums that are increasing, maybe long-term care needs. You have tuition to pay for kids or grandkids, medical school, law school, grad school, etc. The potential replacement property where you're putting the proceeds into is not optimal or even detrimental to your financial situation. And lastly, before I go
Uh-huh.
on here, your tax professional or attorney advise against it. They are very important voices in the entire process.
Yeah, it's a really good point. A lot of times outside of, the tax elements, obviously there's the business acumen of saying, is this deal make sense? Is this the right investment to go in given the framework and the context in which I'm trying to do business as well? So what are some of the most, I guess, overlooked benefits of the DST, just even beyond like the tax deferral component? Because the average investor rarely considers that might even make a really big difference.
Yeah, some of the things beyond just tax deferral, which is obviously a huge component, is there's no personal guarantee on the lease or the financing. Typically, most DSTs have already obtained financing for which the beneficiaries or the investors don't have to qualify or apply for. They don't make any loan payments. They're not personally responsible or liable for a loan. There's no recourse. There's no capital calls. There's no corporate or entity fees. There's no typically any day-to-day management issues. The properties have already been acquired. It's a prepackaged solution. Typically, they're cash flowing from day one, and closing takes significantly less time. And the money that's inside of the trust does have creditor protection. So those are some of the benefits of non-tax deferral of being in a trust like a DST.
It's really an important aspect of it too, because a lot of times you look at, okay, well, I need the tax benefit. That's great. But then you have all the other elements of when you get into a deal, the amount of time that goes into it, the headache that goes into it, the time suck can be a really big once you're taking that off the table, and even the risk. So just, all of a sudden you're taking on recourse risk, you're taking on legal risk, which, never really seems like it's a big deal until you actually are on the other side of a lawsuit. So that's a really big deal as well, creditor protections. So can you walk us maybe through the anatomy of a top tier commercial real estate opportunity? What's behind the scenes, due diligence checklists you live by, maybe?
Yeah, I would say that the two major components of my checklist, and of course there are a lot of
Mhm.
individuals and institutions and firms that do conduct due diligence, but of course I have my own. I look at the sponsor company, that's the issuer. I look
Mm.
at their history, of course, their experience, their commitment to investors, their customer service, which is vitally important, their
Mhm.
management capabilities, their exit strategies. If they utilize a sub-advisor, meaning they're just
Mm.
raising capital, but someone else is actually doing the investments, the same sort of format goes for that. And then the real estate, obviously the tenant, who's paying the rent, the location where it is, and of course the lease, how long it is and how it's structured,
Mm.
financing if it's utilized, and sort of the business plan and exit strategy. I do look at the pro formas of the income versus the expenses. I will say, Dave, that some firms have excellent real estate and let's just say average management.
Hmm.
And some firms have very impressive management and average real estate. A few firms have it all, but I mean that could be said about just about everything in life. But I really look at the sponsor who's issuing, who's raising the capital, and obviously the real estate, what it is, where it is, who's paying the rent. Those factors are critically important.
Yeah, you have the people component of how are they A grade in the way that they operate. Then you have the asset itself that you're trying to look at to just see is are they making investments in deals in of themselves that make sense. You have both sides of this coin matters. So let's get into the some of the driving and factors of success in the alternative space, and maybe even just talk about behavioral finance. So like how do investor emotions show up in commercial real estate investing, and how do you help clients pull back from fear or hype? In your experience, what's the difference between investing in alternatives as a tax strategy versus an income strategy, and how should investors frame the goal first? So yeah, maybe you can walk me through a little bit of that and we can keep pressing in.
Yeah, the behavioral finance aspect is a fascinating topic that truly transcends age, net worth, education, nationality. Sometimes after educating clients on all the potential solutions, they don't do anything.
Hmm.
They're just kind of that emotional fear of making a decision. Others can't wait to get rid of their real estate. And that's, typical factors, property management
Sure.
duties, taxes, insurance, HOA fees, et cetera, whatever it may be. In many cases, emotions take over and they just can't fathom selling their real estate. Maybe it's their grandparents who immigrated to the United States, started a business, a warehouse, and
Hmm.
it's just too many emotions in that building, even though it's potentially in their best interest to sell it. Behavioral economists call this anxiety adjusted returns.
Hmm.
And what it's worth to you, both monetarily and the emotional impact. And I've dealt with that a number of times where people just can't fathom selling it, regardless of the numbers.
That's an important thing to know when you're looking at just investments as a whole, because if you really just boil it down, it's not complicated if you just sort of follow some steps and do it. And if that was all it was, you could just go pick the book out of the bookstore and you'd be done. But it's way more complicated than that. There's so many different factors, and a lot of that is psychology. And so, what would you say are some of the commonly missed risk, either operational or structural, that investors need to be asking about in today's DST or private placement deals?
Yeah, I would say that for DSTs, because it is a irrevocable trust and not much can be changed. So that's kind of set in stone. Obviously, real estate is, obviously critical and the most important inside a DST as it pertains to sort of these private placement deals, which can include private equity, venture capital, private credit, and real estate. Deal structures are really all over the place.
Huh.
However, the trends and best practices are lowering the management fee and having higher preferred returns with a friendlier waterfall. The baseline for really decades was for these private funds to charge typically a 2% annual management fee and taking a 20% preferred return above a specific threshold, sometimes as low as 6%. Now, some funds still do this,
Uh-huh.
but many have adopted to different terms that potentially benefit the investors. I guess it's somewhat analogous to public company CEOs that take smaller salaries, famously Steve Jobs and I think it was John Mackey of Whole Foods pay themselves $1 a year salary, and the rest took in deferred compensation. But I'll say this, and I think this is an important point: just because a fund has low fees doesn't mean it's a good investment for that investor.
Yeah.
And just because a fund has potentially higher fees means it's a bad investment.
Yeah.
Compared to cars, just because a car has maybe not the best gas mileage, it may be a good vehicle for that particular person or family. So it really just depends. But really the trend is for lower fees, particularly on the upfront component.
Yeah, that's more tied to performance as opposed to just, heavy set fees up front. That makes a lot of sense. And I think it's a really good point too for people to remember is when you're looking at it, you really do have to have an objective way that you go about it. And you need to have an advisor and somebody that's walking through the due diligence to say, here's the reason why we're objectively making this decision. And it's a holistic perspective, not just one particular thing. It's fees. I always say that to clients too when they're looking to loan. They're like, man, that interest rate is high. And I said, well, got to look at the whole thing. It's not just one thing for sure. Let's talk about future trends and timeless principles. So have you seen the landscape of alternative investments evolve since the early days of the coal capital? And, what do you think is coming next for investors and what they should be preparing for? Because alternative investing and the alternative space, even private credit, it's huge. I mean, it's close to $2 trillion just in the private credit space. So I'd love to get your perspective on that.
Yeah, from my perspective, I think much has changed in the last 2 decades, and it's for the better. As a new industry, as it matures, it learns, it grows. As it pertains to the DST world, numerous big name institutions in the last really 5 to 10 years have entered the industry and offer access to newer asset classes that have substantial track records in other investments, but still very substantial track records, utilize best practices, offer exit strategy solutions, particularly that were not offered 20 years ago when it was more of boutique firms that were offering DSTs. So it's really been the advent of large institutions, big name institutions that have entered the space.
Yeah, there's a lot more people coming in. It seems like there's more decentralization happening as well, as best as that I can see. So if you had to leave our audience with one principle to navigate the complexity of today's tax efficient investing world, what would it be?
Yeah, this is more of a strategic financial planning question, but an extremely important one. I'll say this first and foremost, always speak with your tax professional, as they are very important voices in the process. Secondly, clarifying any potential tax implications and what impact it may or may not have on your situation. And I said this previously, but just because something is tax efficient does not always mean it is the right situation for you. A very important point is, asset location is as important as asset allocation. So I'll just sort of give an example. Municipal bonds, which have some tax-free components, you don't want to put them in a tax-free account or tax-deferred account like an IRA. You want to put that in your brokerage account. Putting your real estate in an S corp can get tricky upon the sale. Putting a rental property that you own as an investment in your self-directed IRA can have some tax implications depending on what it is. So whether it's a brokerage account, an IRA, a trust, an LLC, an S corp, where you put the asset as is important of what you decide to invest in. So that really is, in terms of tax efficient investing, it really work with your CFP, your financial advisor, your attorney, your CPA of where you're putting that asset, because down the road it could really be quite detrimental depending on where it is located.
Yeah, that's good. So I want to get personal a little bit. Like, tell me, what initially drew you into the world of commercial real estate and financial advisory?
Yeah. Well, in my previous, in a previous chapter of my professional life, I was in business development and marketing, raising capital from investment advisory firms, financial advisors, and institutions for real estate funds. I guess you could say I fell into it. About 25 years ago, maybe aging myself. That's actually more than 25 years ago. I worked in a marketing firm launching consumer products. Although I enjoyed raising capital, I was and am much more passionate about working with individuals, families, and business owners. And it's really two separate groups. It's individuals versus institutions. And I really just prefer working with people, families, and those that own small businesses. I'm a big believer in lifelong learning. And I think reading and learning is the best meta skill that's critically important when you work with a variety of people and a variety of situations. And it's really sales versus consulting. I mean, you can say everyone's a salesperson, but I really enjoy the consultative approach. And I think it just has fit my sort of passion and skill set more conducive to working with individuals.
Yeah, that's good. So at Cyna 1031 Advisors, you focus on tax efficient strategies. Could you explain why tax deferral is such a critical component of commercial real estate?
Yeah, so this is the issue about real estate. When you sell it, there are 4 sets of taxes, potential taxes, possibly a fifth depending on what state you live in. We're not going to talk about that today. But the 4 sets of taxes are your federal tax or capital gains tax, which goes up to 20%. Your state tax. Some states have a 0 state income tax. Texas, Florida, Tennessee are some of the states. Arizona, we here have a 2.5% flat tax. The state of California, their highest income tax level, state tax is 14.4%. I'll let that sink in. Then there's the net investment income tax. That's sort of finance geek for the Medicare surtax. That's at 3.8%. And then the Section 1250 depreciation recapture tax, and that's at 25%. That can be a very unpleasant surprise. Oh. And what that is every dollar that you depreciate, and that's typically equipment, plant, property, and equipment, every dollar you depreciate upon the sale of your real estate, you have to pay 25% of that back to, obviously, Uncle Sam. So again, 4 sets of taxes: capital gains tax, up to 20%, state tax, some 0, up to some, California up to 14.4%, your Medicare surtax 3.8, and then the depreciation recapture tax. And I'll remind everyone again, please consult your tax professional well in advance when you're thinking about selling your real estate.
Yeah. A lot of taxes. They're coming at you.
Yeah, all directions.
Yes. So how do you approach personally and professionally, collaboration with clients who they're business owners looking to manage real estate as part of their business holdings?
Yeah, Dave, I do work with a lot of business owners, and some of the key issues that come up frequently is the structure of the business and where the asset is held. Is it in an LLC? Is it an S corporation? Is it a C corporation? Is it in a trust? Who's involved? Who isn't? What are their plans? This can get complex and tricky if certain business partners or family members want to go in different directions, right? They have a property, it's in an LLC. One business partner wants to sell and pay taxes. The other one wants to do an exchange. Planning well in advance of selling your business and the real estate associated with it is highly recommended. And I, again, encourage having an attorney who is knowledgeable about business structures, and the process of moving out of one structure and into another is essential. So that's, when I talk about business owners, of who's involved, who isn't, what's the strategy? Is everyone kind of rowing in the same direction? And there's certain pros and cons of each structure. And sometimes people that have owned businesses for decades don't realize what the decision that they made, which made sense at the time, now that they're getting out and monetizing, that it, can be a real issue from a tax perspective when they go to sell.
Yes, it can. So we're in a volatile market. If you haven't had your head in the sand, it's always an issue. And so how do you help your clients maintain this longer term perspective on their investment strategies?
Yeah, well, it goes back to sort of the behavioral finance component, and it's the investor psychology and the emotion behind it. But, as it pertains to real estate and really a lot of investments, maintaining a long-term perspective, the 2 factors that are typically the most important are the lease. And if you have a long-term lease, 10, 15, 20 years, and any financing associated with it, let's say it's a 7 to 10 year note, If you own a property with a long-term lease with long-term fixed financing, in some cases, that potentially could transcend a mild economic downturn because you're locked in and there's no decisions to make and you can't get out. Now, that's not to say that short-term leases and short-term financing absolutely have advantages pertaining on the asset and, of course, the macro economy. But, some like Warren Buffett, they buy and hold forever. But for real estate, it's, if you're locked into a long-term lease with a good tenant and financing that doesn't need to be changed or refinanced, you can stay put. And many times it's like, take Mr. or Miss Investor, take a deep breath. You're locked in for a while. You don't have to refinance anything for quite a bit. Let's, ride it out if you have to.
A lot of ups and downs. So we're coming to the last question. And as you're looking ahead, what excites you most about the future of commercial real estate and financial advice?
I would say as it pertains to being a financial advisor, we've talked about people are very emotional creatures, especially as it pertains to money. As the world continues to move towards artificial intelligence, frightening of what may happen and also exciting of what the possibilities are. Many people, I don't want to talk for everybody, but I think many people would prefer to deal with an actual person. I think those that provide financial solutions to people should benefit. I think just customer service and handshakes are just never going away, regardless of what computers and technology are able to provide. Pertaining to commercial real estate, I think it's a very exciting time to see so many places around the U.S. transform into these technology, data center, semiconductor, manufacturing. You look at states like here in Arizona with the Taiwan Semiconductor, investing $165 billion, and what that's doing to all things along the I-17, states like California, Texas, Pennsylvania, Ohio, Vermont, Oregon, a lot of things that are being built around there, these enormous facilities, but it's not just the enormous facilities, it's the multifamily housing going around it, the retail centers, the office, sort of, everything that's kind of built around it that's going to be sustaining it. So I know there's some people think that America's overbuilt. I think in some cases it's under demolished, depending on where it is. But I think it's a very exciting time what's taking place, particularly here in the Phoenix area.
Agreed. This has been a great discussion. We've been able to go through this concept of 1031 exchanges. What is it? Why does it matter? How does it impact you as a commercial real estate investor and developer? Maybe some of the nuances about a DST that you didn't know before. And so as we close out, and we're super thankful for the time and the expertise that Ethan has brought to us. Ethan, how could somebody get a hold of you? What's the best way?
I like it. I'm an old fashioned. You can call me. My number is 480-433-6094. Just let me know you spoke to Dave or listened to the podcast, and happy to have a conversation.
Sounds great. Well, it was a pleasure to have you, and we will see you on the flip side.